In this video, we're going to talk about the classic moving average crossover strategy for swing traders. Stay tuned. Hey traders, a very warm welcome to you. Okay, so you're probably familiar with this strategy. It is called the classic moving average crossover strategy, predominantly a strategy used by swing traders. I want to look at the rules of it. I want to look at it in more depth. And most of all, I want to see if we can actually use it to make any money in the market. So the general rules are this, and there are little tweaks, and we'll talk about some little tweaks and adjustments we can make to the classical strategy later in the video, but let's talk about the traditional rules. So the rules state that as the fast moving average crosses above the slow moving average, you go long. And it's probably a good time to mention that moving average, if you're not familiar, is literally an average of price. And a fast moving average is normally determined something like a 5-day, a 10-day, a 20-day, a 25-day, something like that. So in other words, it's taking the average price, closing price usually, you can have the high or the low or the midpoint. But generally speaking, it's the close, and it's going to be the average of price over that 5-day, if you're using a 5-day, 10-day, 20-day, etc. So it's just an average. And the kind of lower the number, the quicker the moving average, the less smoothed price is. So it moves a lot more closer to the closing price, as opposed to a slower moving average, which is normally the 50-day, 100-day, 200-day, or anything in between, that kind of thing. Much more of a smoother line. It smooths out a lot of the noise and short-term movement in price, because it's taking a longer period. 100 days a long time, 200 days a long time. Taking that average, it takes a while for that moving average to move, and as price is moving. So it's lagged, but it's smoothing out. So you've kind of got that yin and yang of lagged versus smoothing. So the fast is kind of the short time frames, and slow is higher numbers, should I say, numbers, not time frames. So what we're looking for here to go long on the classical setup is that as the fast crosses above the slow, then we go long. As the fast then crosses below the slow, so it comes back down to the slows here, the fast crosses down below, crosses to the downside, we exit the long, and if we want to, we add an extra layer in, or an extra executional strategy in there, that we go short. So we exit the long and we go short. Now, you don't necessarily have to do that. A lot of people will just want to stick to long because they're using it in a bull market, or they believe that the market's trend up over time, which is generally true, and so they just want to stick with long-term stuff, long stuff in a swing trading account, as opposed to going short and try adding that extra layer of complexity to the strategy. So that's generally the rules for it. Very, very simple, very, very easy. Every charting package has a moving average on it. If not, you can easily do them manually. It's very, very simple to do. So this is a kind of rough visual representation of what that would look like. We've got price here in the blue, which is sort of exhibiting a bit of a growth in trend, and assume that something's happened over here that's changed the kind of move, and we've now started, price has picked up. We've got the slow moving average in red here, which is much more of a shallow curve, as you can see. The fast moving average, which is much more kind of pinned to price. It's not quite as tight as price, but it's got those little movements. As price accelerates up, you get a little burst in moving average, starts to curl down. So the start of the entry would be here, when our fast moving average, the green, crosses above the red. So that would be our long entry right there. Now, a good time probably to mention that some people also use the fact when price crosses the moving average. That's one way of doing it, but let's talk about the classical moving average strategy for now. Fast has crossed over the slow line. This is when we're going long, and the equivalent price is probably going to be around here. So that's our long entry if we're using the classical moving average strategy in swing trading. And the idea being is we hold this all the way until the fast then crosses below the slow. Now, I've highlighted here how we could come out of the trade. I've also want to point out something, the weak spots in this strategy, because it sounds great, but there are lots of weak spots with this. And this really here is our weak spot, because You know, in reality, we want to kind of stay in the trend. The idea is that we're looking to capture long trends. The dream of this setup is to get involved in something that starts to curl at the bottom of a trend, the fast moving average crosses above the slow, you pile in long, and the thing just rallies on for months and months and months and months, if not years. And eventually, you know, price stagnates, the moving average crosses down, you take your big profit and you do that over multiple markets. That's the theory of it. In reality, this is why it's a little bit of a tricky strategy just to use on its own. You get chopped out, or you get chopped about, should I say, often on noise. And you can see here, you know, perfectly, you'd want to stay with the trend all the way up to, let's say we end up going all the way up here, and then eventually this kind of filters out and the moving average crosses over here. That would be the dream scenario. However, very often, you know, price might retrace a bit, stagnate, the slow starts to catch up, and you get this crossover point here. Now, it's where the fastest crossing below the slow period moving average. Now that is technically where you would come out of the trade, and if you were adding extra layer and you go short, then you'd be back in the trade here, but you're missing out on this point to basically this point. So you're missing out on quite a big chunk while you're waiting for that to turn. So whilst in theory, it's really good. It's a really good strategy. And if you can get on the end of a trend, it's a perfect way of staying in it. There are tons of examples, if you go back throughout the years, of where this strategy looks like it's an absolute dream of a strategy. You can have some real cherry-picked examples where you say, look, I would have captured the whole of the move on this market, right from the low as it breaks out, all the way up till it turns and it comes back down, goes back to low again. I would have been a genius catching that. And that's great. But the reality is, guys, is that this is the problem with it. It's noisy. Do professional traders use this as a standalone strategy? I very much doubt it. I don't know anybody who does. They are more likely to use it as a filter to identify a trending market. So your fast is above your slow. Yes, that ticks a box that gives me some kind of analysis that says, hey, this is reasonably trending, and I can use various levels of moving average to deduce that. But the classical buy as we cross above, sell as we go below moving average strategy isn't really something you want to do long term. Now, these kind of came about back in many years ago when markets would trend, and I know that I've spoken to and I've heard from people who have used this, and they say exactly the same thing. They say, listen, you know, I was following it to the T, I ended up either getting chopped up, I got on some great monster trends with it, but if I was following it strictly, you know, I kind of got 5, 6, 7, 8 trades that just chopped me around. And because of the lagging nature of it, often it's loser, 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 bit of a winner, bit of a winner. So you know, that happens. I know someone as well who followed it very religiously and ended up making, you know, kind of very small money, and they were risking a reasonable amount purely because of that fact of they're getting chopped up all the time. But when markets were much more trending, less volatile, less kind of back and forth ebbs and flows, this would work very well. So if you are going to use it, be very cautious about using it as it's not an edge on its own as such. You can't just literally take some, you know, holy grail combination of a slow and a fast moving average, some special number, bolt them together, and that's going to work for you. No, that on its own is unlikely to work as an edge long term. However, it's a useful tool to put into your arsenal or into your toolbox to give you some guidance on the power of the trend. Or perhaps you've done other analysis and you said, hey, you know what, I think this might be turning now. I need some sort of filter or trigger that makes me a bit more aware, maybe lets me add some to position. Then by all means, you know, using that kind of approach to give you a kind of benchmark to say, well, now I want to look to get involved in it. But blindly taking it on the crossover, as you can see, is kind of a losing proposition over time because of this scenario here. You may well have a beautiful uptrend, but if that fast just crosses over a few times on the way up there because of stagnation or whatever it may be, you've ruined the whole trade. You're not involved in it. You end up chopping, you're getting taken out chunks and chunks and chunks, and in reality you're left with a very small amount of it, and you struggle to get the full juice of the trade. So that's a classical moving average crossover strategy. Predominantly used by swing traders. There are variations to it as well. we can kind of add things like, as the price crosses over a fast period, we can add a third moving average into it, so we can see, okay, when price has got to be above the really slow one, and all those sort of different permutations, and you can play around with it yourself to find something that helps you find better trades, but just being cautious about just trading it as a systematic strategy, because over the long term the edge is probably not what you'd want it to be. All right guys, good trading, keep the risk managed. I'll see you in the next one. Goodbye.